In the intricate clockwork of the global economy, gears turn and wheels spin, driven by forces often hidden from plain sight. Beyond the frantic energy of the trading floor and the daily rhythm of commerce lies a realm of immense power, a shadow world where the fate of nations can be decided by a single, calculated move. This is the domain of the central banks, the unseen puppeteers pulling the strings of the financial system, their influence a quiet but constant presence shaping the very world we live in. We see the effects, the ebb and flow of fortune, the rise and fall of markets, but the hands that guide them remain cloaked in anonymity, their motives as complex as the systems they command. The primary tool in their arsenal, the master lever of economic control, is the interest rate. Picture a shadowy figure, silhouetted against a backdrop of flickering data streams, his hand resting on a vast, imposing lever. With a deliberate, almost imperceptible push, he sets in motion a chain reaction that reverberates through every corner of the economy. When the lever is lowered, borrowing becomes cheaper. Animated blueprints of new factories begin to fill the screen. Construction cranes rise against the skyline, and families are shown confidently making large purchases. The economy expands, fueled by optimism and accessible credit. But when the lever is raised, the cost of money climbs. The blueprints fade, construction sites fall silent, and consumers are depicted tightening their belts, their spending replaced by a cautious instinct to save. The economic engine cools, a deliberate slowdown engineered to combat the specter of inflation. This single adjustment, this manipulation of cost, is the central banker's most direct and powerful method of steering the economic ship through either stormy or placid waters. Yet, in times of profound crisis, when the traditional levers prove insufficient, the central bankers must resort to more dramatic interventions. This is the era of quantitative easing, a modern term for an age-old concept, the creation of money. Imagine a stylized vintage printing press, not churning out paper, but issuing a torrent of glowing currency symbols. These symbols don't enter the pockets of citizens directly. Instead, they flow like a luminous river into a schematic of the financial system, flooding the coffers of commercial banks and financial institutions. This digital deluge is designed to do one thing: inject liquidity and confidence back into a system on the brink of collapse. The goal is to unclog the arteries of finance, encouraging banks to lend and invest once more, preventing a catastrophic seizure. It is a financial floodgate, opened in moments of desperation, a powerful and controversial tool that can rescue an economy from the abyss, but also sow the seeds of future instability. The influence of these shadowy figures extends far beyond domestic borders, playing out on the grand stage of international finance. Envision a metaphorical chessboard, its polished surface reflecting the skylines of global financial capitals. The pieces are not kings and queens, but gleaming symbols of the world's major currencies: the dollar, the euro, the yen, the yuan. The hand of the central banker, shrouded in shadow, reaches out and makes a decisive move, shifting one currency piece. A ripple effect instantly spreads across the board. As one currency strengthens, another weakens, altering the balance of power in an instant. This single action can make a nation's exports cheaper and more competitive, boosting its industries, while simultaneously making imports more expensive for its citizens. It is a high-stakes game of strategy, where each move is carefully calculated to gain a national advantage, influencing trade balances, international investment flows, and the delicate geopolitical equilibrium. As the day ends, the frantic noise of the market fades into the quiet hum of the city at night. The solitary figure of the central banker stands looking out over the sprawling metropolis, a constellation of lights representing millions of lives and livelihoods. The weight of the world rests on his shoulders, a burden of immense responsibility for the stability and prosperity of the system he commands. The camera pulls back, leaving the lone figure, and zooms in on a single glowing economic chart on a monitor. Its line, a complex fluctuating pulse, is a stark visualization of the intricate, fragile system he navigates. In this final image lies the truth of his role: a silent guardian, a master strategist, forever balancing the delicate mechanics of an unseen economic empire. His every decision a ripple in the vast ocean of global finance.